In today's session, we're going to talk through Chapter 10, which deals about management control in decentralized organizations. And when we talk decentralized organizations, the counter or the flip side to that is centralized organizations. And so when we finish today, what we will have done is to define decentralization and identify its expected benefits and cost. We will have distinguished between responsibility centers and decentralization. We will have explained how the linking of rewards to responsibility center performance metrics affects incentives and risk. And we will have computed return on investment, or ROI, economic profit, and economic value added. We'll also have compared the incentives created by income, ROI, and economic profit, or EVA, for performance measures. We'll discuss the idea of transfer prices and identify their purpose. We'll state the general rule for transfer pricing and use it to assess transfer prices based on total cost, variable cost, and market cost. We'll identify factors that impact multinational transfer pricing. And we'll explain how controllability and management by objectives, or MBO, aid the implementation of management control systems. Aid the implementation of control systems. And so when we talk about decentralization, what we're really talking about is the delegation of decision freedom to make decisions, right? So in a centralized organization, decisions are concentrated within a particular group. Perhaps this is the corporate group, or perhaps it is a headquarters group. But the important decisions are held, the ability to make important decisions are held by a handful of few. Decentralization is the process by which this decision making is spread to lower levels. It's sort of dispersed. The ability to make decisions is dispersed throughout the organization, and it essentially provides more autonomy to the organization. More autonomy with respect to decision making anyway. So if we talk about the benefits of decentralization, we can see that managers of lower level units, which we will call as local managers, often have the best information concerning local conditions and therefore are able to make faster and better decisions on local issues than higher level managers, which we refer to as central managers. By delegating decision-making authority to local managers, central managers free up time to deal with larger issues and fundamental strategy. In addition, decentralization gives local managers an opportunity to develop their decision-making ability and other management skills that help them move up into the organization, ensuring that the organization develops future leaders. Finally, local managers who are given more authority often have greater motivation and job satisfaction and enjoy a higher status. So then we talk about some of the cost of decentralization. So local managers may make decisions that are not in the organization's best interest, either because they act to improve their own segment's performance at the expense of the organization, or because maybe they don't fully understand the effects of their decision on other segments and the organization as a whole. Innovative ideas to improve performance are less likely to be shared across units in a decentralized organization. Local managers in decentralized organizations also tend to duplicate services that might be less expensive if centralized, such as accounting, advertising, and personnel. Furthermore, costs of accumulating and processing information frequently rise under decentralization because top management needs additional accounting reports to learn more about and evaluate decentralized units and their managers. And then finally, managers in decentralized units may waste time negotiating with other units about goods or services that are being transferred between units. Organizations make many choices along the centralization-decentralization continuum, and the optimal choice for one organization is likely to differ from the optimal choice for another. Decentralization is most successful when an organization's segments are relatively independent of one another, that is, when the decisions of the manager in one segment will not affect other segments. And also what we see is that organizations tend to move in patterns. So they may move in a decentralized pattern for a while and then move back toward a centralized pattern and then move in a decentralized pattern. So there are a lot of variables that impact the decision to be centralized or decentralized. And again, there's no one right way. It's what works for the leaders and the management of the company at that time. If management has decided in favor of heavy decentralization, then segment autonomy, or the delegation of decision-making power to managers of segments of an organization, is also crucial. For decentralization to work, however, this autonomy must be real, not just lip service. In most circumstances, top managers must be willing to abide by decisions made by segment managers. Design of a management control system should consider two separate dimensions of controls, that being the responsibilities of the managers and the amount of autonomy they have. Some managers confuse these two dimensions by assuming that profit center managers always have more decentralized decision-making authority than cost center managers. The fundamental question in deciding between using a cost center or a profit center for a given segment is not whether heavy decentralization exists. Instead, the fundamental question is, for whatever level of decentralization that exists, will a profit center or a cost center better solve the problems of goal congruence and management effort? In designing accounting control systems, top managers must consider the system's impact on behavior desired by the organization. The management control system should be designed to achieve the best possible alignment between local manager decisions and the actions central management seeks. For example, a plant may seem to be natural cost center because the plant manager has no influence over decisions concerning the marketing of the products. A major factor in determining or designing decentralized management control systems is how a system's performance metrics affects managers' incentives. Incentives are the rewards, both implicit and explicit, for managerial effort and actions. A performance metrics is a specific measure of management accomplishment. Organizations should choose performance metrics that improve the alignment of manager incentives with organizational objectives. The organization wants managers to use decision-making autonomy to meet the company's objectives, not to pursue other goals. Top management must design the management control system so that it motivates managers to act in the best interest of the company. This is done through the choice of responsibility centers and the appropriate performance metrics and rewards. The degree of decentralization does not depend on the type of responsibility center chosen. For example, a cost center manager in one company may have more decision-making authority than does a profit center manager in a highly decentralized company. And so here what we're saying is that accounting measures which provide relatively objective evaluations of performance are important. And that's obviously getting to the point of that you get what you measure. So we want to be careful when we're setting our objectives, setting our performance evaluations and metrics that that those are what we want to measure, and we're willing to live with the measurements that result from that, and whatever those may suggest. So Exhibit 10-2 shows how the design of a management control system affects the actions of managers. Managers have beliefs about how alternative action choices will lead to outcomes for their unit, and the management control system specifies how outcomes translate into unit performance metrics and into both explicit and implicit rewards. Managers' preferences motivate them to select actions that generate outcomes measured and rewarded by a company's management control system. The manager's understanding of how the control system links outcomes, performance metrics, and rewards influences the manager's choice of actions. Thus, the right metrics and rewards motivate actions that are in the company's best interest. The links between outcomes and performance metrics and rewards are critical features of the management control system. While the importance of explicit links is clear, implicit links may also be important. For example, the management control system might include an explicit link that specifies the amount of bonus that will be paid for different levels of profit, but there may be an additional implicit link between performance and promotions. Similarly, it is important to recognize that rewards may be monetary or non-monetary. Examples of monetary rewards include pay raises and bonuses. Examples of non-monetary rewards include praise, better offices, and better perks. Thus, while we often focus on explicit monetary awards, remember that implicit and non-monetary awards associated with outcomes and metrics play important roles in the management control system. Agency theory provides a model to analyze relationships where one party, the principal, delegates decision-making authority to another party, the agent. Agency theory is useful to analyze situations where there is imperfect alignment between the principal and agent's information and objectives. As discussed earlier, it is common for local managers to have better information about their units than do higher-level central managers. Because the local managers have different information than central managers, they make different decisions. Similarly, as discussed in Chapter 9, it is common for the objectives of local managers to differ from central organizational objectives. Agency theory provides us a framework to analyze these differences in designing a management control system. Ideally, companies should reward managers based on their individual performance, but often an organization cannot directly measure a manager's performance. For example, a company may not be able to separate the manager's effect on responsibility center results from the effect of other factors beyond a manager's control. The greater the influence of non-controllable factors on responsibility center results, the more problems there are in using the results to measure and reward a manager's performance. According to agency theory, employment contracts will balance three factors: incentive, risk, and cost of measuring performance. Measures of income are readily available from the financial reporting system at any level of the organization for which a company can identify revenues and expenses, such as subsidiary, a division, or a business unit. Moreover, accountants can easily customize income measures to exclude factors that the company considers to be outside the control of the manager. For example, earnings before interest and taxes excludes the effect of interest and taxes, while earnings before interest, taxes, depreciation, and amortization also excludes the effect of depreciation and amortization. A more comprehensive measure of profitability is the rate of return on investment, or ROI, which is income divided by the investment required to obtain that income. We can write ROI as the product of two items: return on sales, which is income divided by revenue, and capital turnover, which is revenue divided by invested capital. And ROI is another one of these financial ratios that we'll talk about this semester that are often used and compared across organizations, or compared as a trend across the same organization that allows us insight into the performance of the company. Other issues in measuring invested capital, or whether to value the assets contained in the investment base at gross book value, that's the original cost of the asset, or net book value, that's the original cost of the asset less any accumulated depreciation, and then whether to base the values on historical cost or some version of current value. Practice is overwhelmingly in favor of using net book value based on historical cost. This means the number used for performance metrics are consistent with financial numbers reported to the public. However, the alternatives are attractive in certain circumstances. We first examine the historical cost versus current cost issue, and then discuss gross versus net asset values. So asset values include beginning asset values, ending asset values, or some average of asset values. So what's the right asset value? If investment does not change throughout the year, it will not matter whether we measure assets at the beginning, the end, or the average for the year. However, if investment changes throughout the year, we should measure invested capital as an average for the period. And so then we talk about the valuation of assets and why is that important. And it's important because income is a flow of resources over a period of time, and we should measure the effect of the flow on the average amount invested. The most accurate measures of average investment take into account the amount invested month by month or even day by day. However, a simple average of the beginning and ending balances often provides nearly the same result without going to the trouble required to produce greater accuracy. And so now we turn to this idea of economic profit or residual income. That is defined as net operating profit after tax less a capital charge. Net operating profit after tax is income before interest expense, but after tax. The capital charge is the company's cost of capital multiplied by the amount of investment, where the cost of capital is the cost of long-term liabilities and stockholders' equity, weighted by their relative size. In short, economic profit tells you how much a company's after-tax operating income exceeds what it is paying for capital. Net operating profit after tax is income before interest expense, but after tax. Economic value added is equal to the adjusted after-tax operating income minus the cost of invested capital times the adjusted average invested capital. So why do some companies prefer economic profit or EVA to ROI? ROI can motivate divisional managers to make investment decisions that are not in the best interest of the company as a whole. Under ROI, the basic incentive is to maximize rate of return. This leads division managers to invest only in projects that will increase their division's ROI. That is, projects with an ROI greater than the division's current ROI. For example, if a company measures performance using only ROI, the manager of a division currently earning 20% may be reluctant to invest in projects that earn 18%, even if accepting such a project would be best for the company. When a company uses economic profit as a performance metric, managers have incentive to invest in any project earning more than the cost of capital because such an investment will increase the division's economic profit. Despite the success of economic profit and EVA, many companies still use ROI. And that is probably because it's easier for managers to understand and it facilitates comparisons across divisions. Furthermore, combining ROI with appropriate growth and profit targets can maximize ROI's dysfunctional motivations. To apply either ROI or economic profit, we must measure both income and invested capital. However, there are many different interpretations of these concepts. To understand what ROI or economic profit figures really mean for a particular company, you must first determine how the company defines and measures invested capital and income. And so next we want to talk about the idea of transfer prices. A major source of potential conflicts between segment and organizational interests occurs when one segment sells products or services to another segment of the same organization for a price called the transfer price. When one segment produces a subcomponent and sells it to another segment that then incorporates it into a final product, the transfer price is required. Transfer prices also apply to services, such when a project manager buys advertising services from the market support segment. The transfer price for the subcomponent is revenue to the producing segment and a cost to the acquiring segment. Thus, a change in the transfer price increases the computed profit for one segment and decreases the profit for the other segment. However, it does not affect profit for the company as a whole. Management wants to create performance measurement systems. Decisions that maximize a segment's profit should also maximize the profits of the entire company. And so what does a company want from its transfer pricing system? Ideally, when a company evaluates a segment based on profitability, it wants profitable metrics that reward the segment managers for decisions that increase both a segment's profitability and the profitability of the entire company. For example, transfer prices should guide managers to make the best possible decisions regarding whether to buy or sell products and services inside or outside the total organization. Decisions by the buying and selling segment managers acting without top management intervention should be the best decisions for their segment and for the entire organization. In other words, Decisions that increase a segment's profit should also increase the profits of the entire company. Another common goal of transfer pricing systems is to preserve segment autonomy. Organizations use a variety of transfer prices: cost-based prices for some transfers, market-based prices for other transfers, and negotiated prices still for others. Therefore, don't expect that a single, universally applicable answer to the problem of transfer pricing exists. There is no perfect transfer pricing system. Almost every manager in a decentralized organization has had experience with transfer pricing systems that seem less than ideal. Although no single rule always meets the goals of transfer pricing, a general rule can provide guidance. Transfer price equals the outlay cost plus the opportunity cost. For example, suppose the fabric division's $4 opportunity cost arises because it can get $10 by selling the fabric to a buyer outside the company. Thus, the foregone contribution by not selling to the outside buyer is $10 minus $6 or $4. At any transfer price less than $10, the selling division is better off selling fabrics to the outside buyer rather than transferring it. Thus, the minimum transfer it would accept is $6 plus $4 or $10. For the fabric to be profitable to the sportswear division, it must be able to sell the final product for more than the transfer price plus the other cost it must incur to finish and sell the product. Because it can sell the golf shirt for $25 and its other costs are $12, the maximum transfer price the sportswear division will be willing to pay is $25 sales price minus the $12 other costs, or $13. Because transfer pricing systems have multiple goals, there is no universally optimal transfer price. Nevertheless, the general rule provides a good benchmark by which to judge transfer pricing systems. We will analyze the following transfer pricing systems, the most popular systems in practice, by examining how close the transfer price comes to the benchmark of outlay cost plus opportunity cost. So we'll talk about market-based transfer pricing, cost-based transfer pricing, and negotiated transfer prices. So when there is a ready market for an item or service transferred from one segment to another, transfer pricing policies are straightforward. The common maxim is, if a market price exists, use it. The more competitive the market, the better the maxim applies. If there is a competitive market for the product or service being transferred internally, using the market price as a transfer price will generally lead to goal congruence. And that's because the market price equals the variable cost plus the opportunity cost. So when market prices don't exist, most companies resort to cost-based transfer prices. In fact, about half the major companies in the world use a cost-based transfer pricing system. However, there are some possible definitions of cost. Some companies use only variable cost. Others use full cost, and still others use full cost plus some profit markup. Some use standard cost, and some use actual cost. So cost-based transfer pricing are easy to understand and use, but they can easily lead to dysfunctional decisions. That is, decisions in conflict with the company's goals. The key to successful cost-based transfer prices is to minimize such dysfunctional decisions. Let's examine a few of these cost-based transfer pricing systems. Full cost transfer prices include not only variable costs, but also an allocation of fixed costs. In addition, some companies also add a markup for profit. This implicitly assumes that the allocation of fixed costs is a good approximation of the opportunity cost. In cases of constrained capacity where the selling division cannot satisfy all internal and external demand for its products, the opportunity cost is positive. In such cases, variable cost transfer prices are problematic. However, there's no guarantee that adding an allocation of fixed cost with or without an additional profit component is a good approximation of the opportunity cost. Yet it may be a better approximation than assuming a zero opportunity cost. Dysfunctional decisions arise with full cost transfer prices when the selling segment has opportunity cost that differs significantly from the allocation of fixed costs and profit. In our example, suppose the fabric division has excess capacity and thus nearly zero opportunity cost. A variable cost transfer pricing system is most appropriate when the selling division foregoes no opportunities when it transfers the items internally. For example, when there is plenty of excess capacity in the selling division. Variable cost transfer prices cause dysfunctional decisions when the selling segment has significant opportunity cost. Finally, companies heavily committed to segment autonomy often allow managers to negotiate transfer prices. The managers may consider both cost and market prices in their negotiations, but no policy requires them to do so. Supporters of negotiated transfer prices maintain that the managers involved have the best knowledge of what the company will gain or lose by producing and transferring the product or service. So open negotiation allows the managers to make optimal decisions. Critics of negotiated prices focus on the time and effort spent negotiating, an activity that adds nothing directly to the profits of the company. And so we talked about the different approaches to transfer pricing, that is full cost pricing, variable costing, and negotiated transfer prices. And there are advantages and disadvantages to each. And like so many things in business, there's not one that is universally better than the other under all circumstances. So it does become a matter of analyzing. It becomes a matter of people issues. It becomes a matter of delegation and accountability and responsibility issues that have to be dealt with. Multinational companies use transfer prices to minimize worldwide income taxes, import duties, and tariffs. For example, Nike might prefer to make its profits in Singapore, where the marginal corporate tax rate is less than half the rate in the United States. Suppose a division in a high-income tax rate country produces a component for another division in a low-income tax rate country. By setting a low transfer price, the company can recognize most of the profit from the production in the low-income tax rate country, thereby minimizing taxes. Likewise, items produced by divisions in a low-income tax rate country and transferred to a division in a high-income tax rate country should have a transfer price to minimize taxes. And so, obviously, tax authorities also recognize the incentive to set transfer prices to minimize taxes and import duties. Therefore, most countries have restrictions on allowable transfer prices. U.S. multinationals must follow an internal revenue code specifying that transfers should be priced at arm's length market values or at the price one division would pay another division if they were independent companies. Even with this rules, companies have some latitude in deciding on an appropriate arm's length price. So consider a high-end running shoe produced by Irish Nike division with a 12% income tax rate and transferred to division in Germany with 40% rate. In addition, suppose Germany imposes an import duty equal to 20% of the price of the item and that Nike cannot deduct this import duty for tax purposes. Suppose the full unit cost of a pair of shoes translated to US dollars is $100 and the variable cost is $60. If tax authorities allow either variable or full cost transfer pricing, which should Nike choose? And so if we work through the mechanics of this, by transferring at $100 rather than $60, the company gains $3.20 per unit. So now we're going to talk about this idea of management by objectives, which describes the joint formulation by managers and their superiors of a set of goals and plans for achieving the goals for a forthcoming period. For our purposes here, the term goals and objectives are synonymous. The plans often take the form of a responsibility accounting budget, together with supplementary goals such as levels of management training and safety that managers may not incorporate into the accounting budget. The company then evaluates a manager's performance in relation to these agreed-on budgeted objectives. It is important that managers' expectations be consistent with those of their superiors. Organizations can minimize many of the troublesome motivational effects of performance evaluation systems by the astute use of budgets. We cannot overemphasize the desirability of tailoring budgets to a particular manager. For example, either an ROI or an economic profit system can promote goal congruence and managerial effort if top management gets everyone to focus on what is currently attainable in the forthcoming budget period. And finally, of course, using budgets as performance targets also has its dangers. We pointed out how misuse of budgets for performance evaluation can lead to lying and cheating. Companies that can make meeting a budget too important when evaluating managers may motivate unethical behavior. And obviously that's something we don't want. And so that concludes our discussion of Chapter 10. Please go back and read the text and make sure that you don't allow this audio to substitute for a thorough reading. And then please move into the learning exercises and the discussion forums. And thanks very much.